Hi everyone, Nick Shaheen here, Benzinga, MarketFi, create income with option spreads, recapping week ending May 9th and looking into next week. Quite a tumultuous week, and if one looked at it from afar, would think it was boring, but it was definitely far from boring. We had some whipsaws up, down, sideways, and especially with the momentum stocks. What was clear this week is that the markets have rejected the notion of profits in the future. They want to see something now. Not even Amazon was able to escape it this time around. The idea of future profits at basically no margins now is no longer accepted. That was evident, like I said, with Amazon and Netflix, because Netflix was getting a pass on the idea of future growth as far as global development. But it seems like it's not. It's going to be as easy. It's not going to be as easy as it was for them here, say, or Canada, or maybe the UK. Infrastructure comes to play, and different countries have different levels of acceptance as far as speed. So, having said that, what are we looking at? The week was fairly predictable in the sense where we knew definitely there's going to be unpredictability. So we could rely on unpredictability, volatility, whipsaws, call it what you want, chop, big chops. But what was predictable about it were the ranges. All week long, we've predicted the ranges, updated every day to members, and we were dead on the whole week. Especially evident in the SPX, the SPY, and Apple, and also on the RUT, which is the small cap, and the IWM representation of it. We had some pretty well-defined range, and it was incredibly accurate. For example, on the SPX, we ranged it. We said support is going to be here, resistance. That was the easiest thing, the resistance part. Every week, every day, I would update the resistance, and it seemed like a repetitive thing. Okay, 1875, we still see some resistance here. 1880, a little stronger. 85, 90 is this, and 95, 19. The 1900 was is still a wall. Next week might change. I'll update you on Monday, or members on Monday. But the point is, if you look at here's the cash, and you can see the levels, and you can draw a line. When doom hit right here over this period of time here, the world came to an end, and we touched 1855 on the cash. So, we didn't even touch 1850 on the SPX. So if somebody wanted to profit in this range bound, they can do an iron condor, which means sell credit put spread, sell risk below the support. Give yourself some breathing space in case you're wrong a little bit, and then sell some risk above it, and both will expire for maximum gain, or book one as book profits as they come. I'm not overstaying my welcome in any profitable trade at all anymore. I don't trust it. So the iron condors are working here. In Apple, everybody's chasing 600 and above. I kept on harping. It's not going to go farther than 600, much farther. Yeah, it broke off 602, 3, whatever it was. But the 600 magnet was too big. There were too many call options open over there. So that dropped. And then again, we had the news. And of course, even with the bad news, I had some support levels that we had drawn on Friday before the open, and the support levels held. I said 585 should provide support, 87.5 is nothing, and start of support at 585, 580 should be much stronger support. And look at this, 580.33, and boom, bounced right off a couple times, and then closed at 585, which was the halfway, almost right in between 82.5 and 87.5, which was my pin range for it. So right in the middle of my pin range. So even though volatility reigns, predictability of ranges is there. The only thing that's going to blow it up is if we actually finally get the correction. And if on the other hand, we overshoot on the upside. Bulls, if left alone, might overshoot over 1900 in the SPX, for example, because they've been trying so many times. Boom, 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 so many times. And there's pent up energy there. And it's going to, if it breaks, it's going to break for this is like 180 days view. How many times did it try? So are the bears tired of selling that level? And if they are, it's going to break. We're going to overshoot, and then whatever else happens from there. So the question is, are the bears tired of selling that level, or are the bulls going to get tired of trying for it again? I don't think the bulls are going to get tired, and I don't see much energy from the bears. So if I was the guess, I'm more scared of an upside breakout than a complete debacle on the downside. All this with one same assumption: no new bad developments, no new negative catalyst, with all the givens now. Now, if we come up with a headline that's gonna change the assumption, then that's a different story. Given what I know today, those are my ideas. Another stock I was happy to see trade this week was Google. Here's the Google L representation of it. And why am I saying that? Because every day it seems like it got tested. The last couple of weeks before this week, it was treated like a momentum stock. I mean, there was one day it sold off 4% on no news. It sold off like Priceline or worse than Priceline. That's not worthy of a stock of this caliber. This is Google. It sells almost in the low teens. It has earning. It prints money. It's a sure thing. If I'm going to worry about Google and Apple, I better close shop and go away. Those are the least of my worries because they can show me money. Yet twice it get down to 511. That's the Google L. The Goog lower than that. So today the Google L again got tested, but if you look at it, every day it's getting tested recently and it's bouncing right back up almost. Not every day, this was a bad day. But recently, in the last 3 or 4 days, it has been tested and it bounces and closes strong, or bounces and recovers and then closes okay. Today was exceptional. I mean, it was strong all day and it got tested a little bit in the morning whoosh, but then finally recovered and closed up over 1%. So it was definitely a leader today, and I'm glad that it's trying to shed its momentum badge because it does not deserve it. It's not a fast runner unless they come up with something groundbreaking. By the way, rumor late Friday, Google and Yelp some sort of a deal. Don't know if it's true. I rushed and bought some calls in Yelp just in case. I haven't seen anything, no reactions in the prices yet. I tried to look at some options, trades, and I couldn't see anything outstanding. So it might be just rumors, but just in case, I threw a few $100s on some Yelp calls for next week. Okay, so we talked about the indices, we talked about Apple, we talked about Google because those are two mainstays and they represent sentiment for me because those are sure things. And how are people, traders, treating sure things? And then we talk about what's the underlying factor or factors that are making us trade so badly. We have an inverse relationship these days between, I've mentioned it before, you've heard me say it before, between the TLT, which is this box right here, the yen, which is this box right here, and the yield on the 10-year, which is this box right here. So bonds supposedly are the smartest thing in the world, so they are smarter than the stock market, and people say, oh, the bonds are trying to tell us something, whatever. But regardless if they're trying to tell us or not, they are definitely driving prices down. As the TLT rallies, prices go down. As the TNX, which is a representation of the yield of the 10-year, goes down, so do stocks. So you've got on one side the TNX and the stock market trading together, on the other side the TLT and the yen. They rip, markets and TNX go down, and that's been hurting us. And a couple of days ago, the TLT, this one right here, let me see if I can show you, spiked and was threatening a breakout right here, 113. And I'll show you a year of the TLT little, actually, I don't know. That's the TLT 1 year weekly. You can see it's got a coming nice rounding formation and it's threatening to break out, correct? So can you imagine if it broke out with this relationship still at play, where if it rallies, the markets go down? That's what's scaring everybody. So, but I'm seeing it's losing steam. That's a red week. It hasn't had a red week in a while. The one that it had was kind of a doji couple, which means indecision. But the other one was emphatic greens, right? And so just a few days ago on the 2nd, It hit a low in the pre-open, and then a sharp rise in the morning to clobber the markets at 113. But from there, it eased down. It eased down, and then the whole direction of it is down until, let me zoom in a little bit. That's an important part right here, if I can capture right there. Yesterday, we had a bond auction right there, and Rick Santelli gave it a D minus or whatever. Bad, bad result, but that was good for the market because it took a tumble in a minute. As soon as the auction results were announced, TLT went down. Conversely, if you can see it, TLT went down over here, and that's the TNX ripping at the same time over there, the green candle. Green candle coincided with relief for stock markets to run, but they didn't run immediately. But the TLT breaking down now opened up the doors for the next couple of days to be good, and indeed they were. At least they weren't bad. The yen, however, rallied and continued rallying, and now it's still at the upper end of a danger zone. These two red lines I drew because I noticed that every month we have a spike, and these are the ranges to where it threatens the stock markets every time it spikes. So every month we have a spike, and every 15 days, like half of the month, we have a mini spike, and it repeats. But as long as it stays between these two things, we are under control. The last couple of days, it threatened to break out right here, last few days, I should say. But then again, it came back, and now it's under control a little bit. I'll go 5 minutes, so it went back under. Okay, having said that, today my rabbit were the small caps, and even though they got tested hard at the open, I even told the members ahead of time that 1100 RUT 1100, this is the cash, so it's a little lower, 1100 was going to be tested. The market makers were going to revisit it in order to expire a lot of options worthless. Sure enough, we did, and we closed a little bit above it. The market makers made money. So that was, like I said, a lot of instability, but a lot of predictability, which is tradable, especially if you do options. If you do options, then you can time the swings. You can do in credit spreads, debit spreads, or a combination of both, and make money. We'll talk about that in a little bit. Now, we covered what are the underlying factors in there, the TLT, and people still look at the VIX. It's kind of a broken, in my opinion, doesn't do its job anymore. Regardless, look how steady of a trade it is. Every spike, it sells off. Now it's back under 12, and so the only indication, the only way I use the VIX is to see if people are still buying calls in it. Then people are nervous. That's the only indication it does. Level where it's at, it doesn't really. I'd rather short Momos at this time than to buy VIX or VIX calls, because the Momos are falling faster than the VIX is rising. So, buy yourself a few Teslas, Yelps, and Twitters and Pricelines, then you'll be good. Puts, that is, to hedge your bet. If you think the markets are going to fall, short the Momos. So that's the play. Okay, so having said all of that, what are we going to do next week? I think next week we're going to carry the momentum. The traders are going to carry the positive momentum from Friday. This, short of us getting some sort of a shoe to drop over the weekend from China or from Ukraine or from Japan, who knows. So I think China's inflation data was good, so they might not be under pressure anymore to put the brakes on, so that might be good for us. We're going to have economic data next week, so if economic data comes out really bad, then we might negatively react to it. But coming into Monday, we should carry the momentum upwards. But all the technicians or technical analysts that I respect are expecting a drawdown, another slide. So I want to I want to make some money off of that. And how can I do that? I can buy some puts or put spreads, easily represented by buying them in the SPX, for example. Find the levels, off the top of my head. If the same levels from this week are going to work next week, I don't know until Monday morning. I would shoot on the downside to buy something that's in the 60s, 1865 maybe. This will make me have a $5 wide spread that will be all in the money if it comes down and tests the 1860 or 55 or 50. So I can benefit from that. And if I can time it right, as soon as it drops down anywhere near my target, I can sell some credit put spreads way lower in the low 1800s. This will recoup some of the costs I outlaid for the put spreads I bought, therefore making the trade even more profitable. And if I'm right and it bounces right back up as everybody else expects it to, and try to shoot for the upside, then the trade will be so much more profitable now because I almost put it on for half price or free. And then I can buy some call spreads at the cheap, and the level again, I'll probably choose somewhere in the high, maybe 1880, in order to see if they're going to retest the same levels as before and cross 85. This will put my call spread in the money because it's a debit call spread. I'll be happy about that. And I'm not so sure I'm going to sell any credit call spreads above that, just in case we do overshoot. So that's how I can play it. I can do this in any of the indices. I just have to find the right levels, and the levels will be posted Monday morning to members. So if you're interested in that, you can email me at sellspreads@gmail.com or message me through MarketFi. They have a great message board in case you missed it. Let me see if I can do this real quick. Sellspreads@gmail.com. Whoops. Spreads. Sellspreads@gmail.com. That's my email. And I answer every email. So send it over and follow me on Twitter and StockTwits. It's RacerNick, the handle. So levels will be posted, and I'm going to play along those levels. I'm going to look at both the RUT and IWM for the small caps, both the SPY and the SPX, and maybe XPX PM as well, because it's PM settled, so I can trade it next Friday as opposed to it expiring on Friday but not being able to trade it on Friday on monthlies for the SPX, in case you didn't know that. And most likely also a big spread on the NDX. I did a trade on the NDX that paid for the mortgage, basically, not too long ago, and I cashed out of it recently. So all these are doable. There is volatility. It is uncertainty. But you can find the ranges and trade the ranges. Don't get married to a trade. Don't be upset that you're bullish and the market's going down. Profit off of it. Are you long Google? Then play short the SPX, short Momos. If Google falls, Momos are falling. So Priceline, I played it perfectly on earnings. I had a call spread. It looked like doo-doo when it opened because Priceline sold off, but all the signs pointed up. Pretty soon I recovered my cost on the call spread and bought a call spread, bought a debit spread at the whoosh, and then a put spread, and then anyway I played both sides and I cashed out. I didn't wait for it to, I cashed out early. I didn't wait for it to come to fruition to maximum gains. I just cashed out as soon as I saw some green that's worth my while, booked it. Sure enough, minutes later, the greens were gone if I had held on to it, but I didn't. It went up to high 40s, if not 50s, and I said, you know what, I'm out. Don't be so greedy. Boom, out. So you can't overstay your welcome in a winning trade anymore in this environment. They turn on a dime, absolutely turn on a dime. Twitter, Heartbreaker, Priceline, Yelp, Amazon, they show you one way and then go completely the opposite way. Not too long ago, FFIV did it. It was like 15 handles at almost up 5-8%, down 12% by the time it opened. It's just crazy. You cannot make money doing this. So you can do a bi-directional trade. In other words, you can set a trade instead of trying to time the put and call spread. You can set an iron condor, so sell risk on top, on the bottom. So let's see if we can visualize it for you. Yeah, let's go to the SPX since we've been talking about that with all the levels. Okay, this is a pretty tight range. That's 1 year, by the way. It's got a nice consistent upswing to it. We're hitting on roofs, but from higher lows, and two things happen. Either the bears get tired of selling that level and we break out, or like I said, the bulls get tired of knocking on that door and they fall down. Regardless, until they do, I've got good levels. I've got the dotted yellow line here, has held up pretty well as far as support, and the resistance has been very clear. So if I'm comfortable with these two levels, why don't I sell some risk down here and sell some risk up here? I can do it for next week, which is a monthly, or if I'm not that brave, I can go up higher, 1950s or 60s, and go below 18 and go out 2 weeks or 3 weeks or a month or July and make a big trade that you only have to babysit every once in a while. This way you can calculate your risk on reward to the risk involved as far as dollars. The risk is known with regards to dollar amount. You know X, you can lose, you can only lose X maximum. And the event of loss is also known. The percentage of loss, theoretically you can say, okay, I put it up two standard deviations out, so my risk of loss, theoretically speaking, is about 7 or 8% or 5%. So you can do that. It depends on the level of how nimble you are and the level where how tolerable you are or tolerant you are of gyrations in the market. So don't be sitting it out just in case something happens. Nothing might happen. It could all fizzle out. Meanwhile, you could have been profiting. There is risk to it. Options are risky. They can lose you a ton of money. But if you do a spread, your loss is limited to that spread, the risk. You either do a debit spread and your loss is limited to the outlay of the money, or you do a credit spread where you collect some money and your risk is the maximum spread minus the money you collected. So either case, if markets go to 0 or go to 1,000,000, you can only lose X. You know that X, and you know the chances of you losing it in theory. So if you need more information on that, again, email me or message me, sellspreads@gmail.com. I was going to run through a few. One guy I was looking at was IBM, and I was very negative on it, although it held up pretty okay. Lulu is, I posted a write-up on it. You should go check it out on MarketFi. If you can't find it, let me know. And also, RL today was in the news. Ralph Lauren. And it got punished pretty hard. I mean, these scandals, what do you do with this? I mean, I haven't traded Ralph Lauren in a long time. Last time I did, it was a short, and I barely got out of it. I made a little money, and I was happy not to lose. Look at the scandal. Oh my gosh. I mean, how can you trade a stock like that? I just can't do it. Okay, Visa I wanted to go in, and MasterCard I wanted to go in, but then they started becoming headline and involved in Crimea or Russia, and it's like, this is not for me. Goldman Sachs, all the banks have been poisoned. And look at these, boom, 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 boom. I can't invest in a stock like that. I want to go long it, but I've seen head and shoulders here, falling peaks there, knocking on bottoms from lower highs. I mean, it doesn't look that scary here, but you zoom out to 2 years and you can see, ooh, a lot of void down here. So zoom out to 2 years. When you don't understand the picture, for example, LinkedIn, when you don't understand what's going on, zoom out, simplify things, eliminate the noise. This is LinkedIn. Okay, so here I see more upside potential than downside risk, because this level right here, if this level is in doubt, the company should be out of business, right? Because it's been like that forever. So it's worth a shot. How can I do this? I can do a debit call spread or straight out calls out in time, like leaps maybe if they're available there. And you can even finance some of it with a credit put spread if you're brave, but give yourself some breathing room. What do I mean? If you want to do calls for, say, May or second or June, then go out further and do a credit put spread way lower, and then wait for the payout. And if it doesn't happen, you can unfold the whole trade for almost no money. So you're not tied to trading everything tomorrow. Then this is even 5 years for LinkedIn. You see what I mean? I mean, this box right here should be well established. So you're risking another $20-$30. You can make some money on that. I mean, as a matter of fact, now that I'm talking to you guys, let me do that next week. Bank on it. So there are trades out there. You just have to hunt them. And if you have certain tickers, you want to know how to trade them, and you're not sure what to do with them, let me know. Email me, message me. I answer all questions. I answer all questions to the best of my abilities from a educational perspective, just so I can show you what can be done with what. All kinds of lines, right? Because every question will prompt me to draw a line. But I know what these lines mean. Like, this is Amazon, and Amazon, I said from a while back, I'm on record, this blue line, look at where it's pointed. See that blue line? It's pointed exactly where the bottom of that candle was. And I drew this line a long time ago. So it's posted out there. You can find it somewhere. I'm not going to dig it up. I know I did it. I'm not Nostradamus, but it was a possibility, and everything came together for that possibility to come true. So don't be scared of investing. Don't stay out just because. Find the ranges, trade around the ranges. If you have any questions about levels, hit me. Nick Shaheen for at MarketFi for Benzinga, and it's create income with option spreads. Thank you for your time, and it's about a 25-minute long video, which was 5 minutes longer than I wanted to do it. Sorry about that, folks.